Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. Welcome back. What's coming up on the show today, John?
Jim, we're going to talk about the news release Brunswick Exploration finally put out about Mirage, and also about one of the few bottom fish success stories of 2023.
Why didn't the market not like... Why did the market not like Brunswick's Mirage update?
The last time Brunswick Exploration put out a meaningful update was October 5th, and the market had expected updates about how much more outcrops they had found on the Mirage property, how many holes they had drilled, where they were located, were they figuring out the geometry, what sort of scale of a lithium pegmatite discovery was taking shape. And the company could have put out something ahead of Explore at the end of October. They could have put out something afterwards when they closed the private placement on November 17th that they announced just before Explore. And last week we talked about how the market is getting kind of impatient with this and setting the company up for no matter what they put out, when they finally put it out, it's not going to be good enough. And in fact, that is what has happened. On Tuesday, December 5th, they put out an update reporting that the 5,000-meter drill program involved 36 holes, of which they reported assays for holes 1 to 14, excluding number 13, which is still pending. The news came out at a time when the big producer stocks in Australia, Pilbara, Mineral Resources, they've been trending down but starting to get lower. There's a big hedge fund short attack against the lithium producer sector. The juniors across the board have come under pressure. And of course, yesterday, the lithium carbonate price dipped below $8 a pound to $7.93. And who knows how low it will still go before it stops. So there's a big hate on for the lithium sector right now. And Brunswick finally comes out with something that tells us they really are onto something. But it wasn't big enough. It wasn't a peanut, and it wasn't a PMET. They drilled 3 dikes that in a fairly small area of the property where they had documented outcrops. There are 3 zones. They call one the North Zone, and it dips towards the northwest, and they drilled 4 holes into it. 2 of them had very short intervals, and they were obviously in the wrong direction. The other 2 got 25-meter intervals running 2 to 3% lithium oxide, and these holes were about 100 meters apart. So a relatively short segment, a decent thickness for a dike, but very nice grades. The central zone steps to the southeast about 400 meters or so, and they reported results for holes 5 to 12, and they ran only in that sort of 1% to 2% range when they intersected the dike, which in this area dips to the south to the southeast. And then they stepped to the northeast, close to the Inlier claim border, the 175% option from Osisko Development Corp. They did not drill any holes into those claims to the northeast, and clearly this dike system trends onto those claims. And but they have not yet. They did indicate that they had spodumene intervals, but we do not have assays for that. Now the C zone, or the south zone, that's the one that is interesting. They reported only 1 hole for that, number 14, and that was 16.2 meters of 2.75% lithium oxide. The hole number 13, which did not hit anything, it was drilled to the northwest, but this dike also dips to the southeast. So all the other holes were drilled properly to intersect this dike. Now they drilled holes 15 to 27 to the southwest, extending at another 500-600 or 1,000 meters to the southwest, and they also stepped to the northeastern end, where again comes up close to the inlier claims, and that's where holes 31 and 33 are located. Now, the market was unhappy with the reporting format Brunswick Exploration chose. Australian companies and some Canadian companies, such as Q2 Metals, they report not just the assay intervals, but also the azimuth, which is the compass direction from 0 to 360 degrees, and the angle of the holes. And if you combine that with the drill plan, you can plot your own sections. Brunswick only provided 3 sections for several of the holes, so we really have no idea how this all behaves, along strike, because we do not have the angles. We can't put together a little 3D model and do a rough guesstimate. However, what I have done with the segments where they have intersected pegmatite, it totals to somewhere between 1,500 to 2,000 meters. And if you assume 25-meter average thickness and extend it down 300 meters and apply a 2.6 specific gravity, you get a tonnage footprint of 39 million tons based on these 5,000 meters of 36 holes. Now, that's not a PMET. It's also not a peanut. But the CV5 zone, it was based on 163 holes and 56,000 meters, more than 10 times what has been drilled, and it added up to 109 million tons of 1.42%. There's nowhere near enough work been done to accomplish that. And that's why the market has sort of said, well, this is, not a peanut, it's not a PMET, it's a Mickey Mouse. And we're going to Gina Reinhardt's going to send her cat to eat up this little company. And the Australians, who are in a bad mood because their lithium companies are all trending down. Apparently in social media, they were trashing Brunswick Mirage property as just another pump and dump. But in fact, this is the beginning of a world-class discovery. Although the company annoyed everybody by not providing the descriptions of the pending holes, what their angle is, what direction they are, they did provide a drill plan where they showed the trace of the holes, and they indicated pink little segments for where they have intersected spodumene. And you can see that, especially at that northeastern end, there's going to be some very long intersections. And if the grades in the south zone turn out to be the same as hole 14 in that 2 to 3% range, there's going to be a blockbuster set of holes from that end of the property. But to me, this was all great. It's a good start. They're starting a 15,000 meter drill program in mid-January. They're going to do that in all of the first quarter, and that's going to largely focus on this sort of a 2 kilometer area by 2 kilometer area, delineate what they have there, stitch it all together. And I think we're just at the very, very beginning of something big. But there was one comment in that press release that caught my attention. Bob Ware stated that these 3 pegmatite dikes do not explain the bulk of this 3 kilometer long train of spodumene-bearing boulders that's to the southwest in the ice direction. And what's interesting is that the ice direction turns out to be the same as the strike of these dikes, and everybody has been assuming that these boulders kind of got scraped off these dikes where the outcrops start, and the outcrops maybe continue to the northeast. But if these dikes don't explain these boulders, what's going on? And I asked Bob, why did he say that? And he said the 3 pegmatite dikes in the north, central, and south zone, they have a lot of tourmaline and a little bit of muscovite. The boulder train to the south has no tourmaline and no muscovite, which means they come from a bedrock source. I said, well, did you ever find any outcrops in the area of that 3 kilometer trend to the southwest? And he says these boulders are, and they have a huge boulders that dwarf an individual. These rounded boulders, they are buried in overburden. There is no bedrock exposed anywhere. And he was in a grumbling mood saying, we are going to have to do a fence of blind holes underneath this to figure out what the bedrock looks like, where they came from. And I said, well, may these not have been dragged even much farther from the northeast? And when you do some, everybody knows about glacial erratics, how a glacier, an ice sheet, can pick up a quite large boulder, and once it's rafted, once it's up in the ice, it's like it's sitting on a raft flowing down a river. Wherever that ice sheet flows, it will take these boulders. And you can take these boulders hundreds of kilometers. When the ice sheet stops and it retreats, it doesn't actually retreat, it just melts. The boulder just drops on the ground there, and it'll be sitting there, some boulder that's not like anything like the bedrock for hundreds of kilometers. These are called glacial erratics, but it's random where these tend to get picked up. In this case, we have this trend, a couple of 100 meters wide, of very large boulders, all of the similar spodumene-bearing type, just sitting there, showing up out of nowhere. And there's not that many boulders where they do have their 2 kilometers of intersected pegmatite dike. So one alternative theory is that there may have been a substantial ridge to the southwest of where they have been drilling. It got sort of broken up over time, and because of the weathering effect of the freeze-thaw cycle in this part of the world, these big, hard boulders can actually end up being rounded without being tumbled like they are when they are either dragged along the ground, but when they're stuck in the base of a glacier, or in a river setting where they gradually break off all these edges. No, these boulders could be sitting, maybe their expert says that it's maybe 500-meter maximum displacement from their source in bedrock. So in this area to the southwest, where the bedrock's all obscured by overburden, we have this 3-kilometer trend of spodumene-bearing boulders with an abundance of all sizes of spodumene crystals. And an important thing Bob mentioned to me, that in the north and the south zones where they intersected this 2 to 3% lithium oxide, the distribution and size range of spodumene crystals is very similar to what they're seeing in those boulders. And, they don't bother assaying these boulders because a single crystal gets up to, pure spodumene gets up to 8.25%. So you sample a crystal, big deal. What does that tell you? That it is spodumene. It doesn't mean anything. You would have to drill a hole through the boulder to get an average grade of what that boulder is actually grading. But it's quite possible that Mirage is neither a peanut nor a PMET, but a Greenbushes. And Greenbushes, when Talison Lithium had it in 2012, they did a resource estimate. It was 120 million tons of 2.4%. And that was along a 2-kilometer strike, about 100 meters wide, and several hundred meters down dip. So it's quite possible that when they drill underneath this boulder terrain, they will find a pegmatite system that absolutely dwarfs what's so far taking shape in the area that they did drill. So while the data isn't telling us that we have even a PMET at this stage, the scale, the context, and all that is starting to show that this is a contender to be a world-class discovery. And if Gina Reinhardt wants this, she better not send her cat. She's going to have to come herself to get it.
Why did Vanstar settle for a 69-cent buyout offer from IAMGold?
Vanstar Mining Resources, it nets a 20% carried interest in the Nelligan project, which it discovered in 2011 or so, and which IAMGold optioned in 2014 and delivered a resource estimate in 2019 for about 3.2 million ounces, and then increased at the beginning of this year to 5.1 million ounces with a modest drop in grade, still an open pitable scenario. But IAMGold has been very busy developing the Cote project in Ontario, and it ran into cost overruns, had to sell some of its other assets. The big shareholders all got really cranky, and so working on these other projects such as Nelligan, that went on the back burner beyond doing some 5,000-10,000 meter drill programs a year. So Vanstar was stuck in this mode of, well, when are they going to start the economic studies, the PEA, to figure out what it's going to cost to turn this into a mine? And the stock, it has been punished in the market because the market sees it as dead money. Now, the buyout offer is for 0.208 IAMGold shares, and the stock had spent most of the years a bottom fish in that sort of 40 cent range. It had fluttered up to about 45 cents before the news came out, probably because somebody figured out that a few months ago IAMGold approached Vanstar about doing a friendly deal. And the reason this has happened is Vanstar, understanding that, this waiting game is tiresome. It's not good. We got to create value sooner. So it had started shopping the story around to the royalty companies, because the deal is that if IAMGold chooses to carry Vanstar to a bankable feasibility study, Vanstar doesn't have to kick in any more money until then, but at that point, IAMGold would have the right to purchase that 20% interest on fair value based on the numbers in the bankable feasibility study, and Vanstar would retain a royalty of an uncapped royalty of 2%. Now, this would be of interest to a royalty company. You say, okay, we buy this now, we can do our numbers, we can see that this is going to be worth, I've done an outcome visualization at today's price of $1,800 gold for 30,000 ton per day open pit mine running for 18 years. This project would have an NPV at 8% of about 1.8 billion Canadian, and the 20% of that, that would be 20%. So somebody buying out the company now with the 68 million shares and trading at 40 cents or so, that's only like a $30 million valuation. So this could be conceivably 5 to 10 times higher when this buyout is eventually happen. Plus, they would get the royalty, and by then the resource could have been bigger, and in 5 years, the time it would take to get this done, the resource, the gold price could be substantially better. So this might make sense, but there was a hitch to the deal. Ever since IAMGold vested for 75% by delivering a resource estimate, it was in a position to decide, no, we're not going to carry you. We're going to split the cost 75-25. We're the operator. We're going to give you a monthly cash call of 25%. We're going to control the news flow. Good luck, Junior. Go out there and raise the money for this 25%. And it may be a couple of years before we actually put out a PEA that lets everybody sort of see what the value equation looks like. So IAMGold has not threatened that. The relationship with the current management has been quite positive, but that's always in the background. So there was a risk that this might happen. And if a royalty company bought Vanstar, this would probably happen for sure, because IAMGold would say, okay, screw you, we're not going to buy this out. You're going to help pay 25% of the cost, and you're never going to get your 2% NSR. So the CEO, J.C. Sano-Moore, had to consider this, that this kind of hardball tactic would deter a royalty company from ever making an offer, and IAMGold itself could end up deciding, we're going to do this 75-25, and you're going to have 300 million shares out by the time we have a bankable feasibility study, and you'll be worth 50 cents at that time. So they made a decision that was not popular with a number of shareholders who wanted to see something much higher. On the indicated numbers, it was a 69-cent price, but of course IAMGold promptly went down, because this occurred right when gold, after charging over $2,100 Sunday evening in Asian markets, then got smacked down $100 in the past few days, back down to sort of 2040, 2023 type level, which of course anytime gold goes down, it sucks the air right out of the market. But the reasoning also from on the management side was IAMGold probably is not going to survive as a producer that grows itself. When it gets the Cote into production in the first quarter, it will likely become a buyout target itself. So that means, and of course in the first quarter, we might see gold trending higher. So we may see a stronger IAMGold price than the current $3 level or whatever it is at right now. If Vanstar just stayed as this passive partner with no control over Nelligan's destination, it would not track any uptrend like this. Now its upside is hooked to the upside of IAMGold. And again, there was the risk too that whoever acquired IAMGold might have even less interest in pushing Nelligan forward in any hasty manner. So the company made this decision. We better take this offer now, get ourselves a ride on any upside in IAMGold, and move on. So it was a good decision. And in terms of my rational speculation model, if my outcome visualization is correct at 1.8 billion Canadian, the fair value range for a company stuck at the infill drilling stage, indefinitely, is only 5 to 10% of the expected outcome, which for Vanstar represented a range of 27 cents to 53 cents. Now, in normal markets, these valuations are never rational, but right now we're in an abnormal bear market, so we have very rational, sometimes irrational on the pessimistic side valuations. So getting 63 cents, 69 cents right now, that's at just over the upper end of the fair value range. So it is a fair transaction. It eliminates the potential for this to go up 10 times if we get into a crazy bull market. But at the 63 cent level, it's basically double the bottom fish price at the start of the year. And in a year where most bottom fish are down 50% or worse from where they started at the beginning of 2023, this is a good outcome.
John, thank you so much for the update.
You're welcome, Jim.
I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.